Hello friends, a very warm welcome to my channel. In today's video, we are going to do the analysis of Polyplex Corporation, which is one of the leaders in the packaging industry in India, as well as one of the leading players globally. If you're new to the channel, please do subscribe and hit the bell icon so that you get notifications of all the new videos which I upload. And if you are still not a part of our Telegram channel, then do join today as we discuss a lot of interesting stuff on our Telegram channel on a daily basis. So Polyplex Limited started as a company in 1984 and they have 7 manufacturing units strategically located across the globe in different countries so that they can take advantage of those strategic locations to serve their customers. They have more than 33 years of experience in this industry and they manufacture the basic thin and thick films as well as the value-added products in this industry. They have presence in 75 countries and more than 1950 customers, and they are one of the global leaders in this industry in terms of the size of operations what they do as well as in terms of the cost leadership. Let us understand the value chain of this industry first so that we can understand the business model of the company better. So starting with the natural resources like oil and natural gas, there are basic petrochemicals first made. And using these petrochemicals, the raw materials of the PET films are made. Raw materials like resins are made, which are in turn used to make the PET films which this company manufactures. And after making the basic PET films, then the PET films are further processed and value-added products are made by doing coating, metallizing and other transfers. So this company is a vertically integrated company and that's why they are into the backward integration and manufacturing of the resins as well as forward integrated, and they are also into the coating, metallizing and the transfer of different films of their products. The red box on the screen which you see is the product range which this company manufactures in the entire value chain. Now let's begin the industry analysis. A few trends in this industry are that these products are now further used in the healthcare sector as well as the EV batteries. So this brings up new opportunities for this sector. Any company operating in this sector has to continuously upgrade their technology. If they stick on to the old machines and other equipments to be manufactured, if the product changes, then they have to do the entire capex upgradation, which will involve a lot of money for them to manufacture newer products. In terms of capacity, by 2024 in the thin PET films, approximately 1.23 metric tons of capacity is expected to be added, which is approximately 50% of the capacity of China presently. So there is huge scope of growth in this industry. Now if you see the global thin PET demand growth in terms of the KMTPA, which is metric tons per annum, it is growing at a range of about 5 to 6% CAGR every year and it is expected to continue growing in that range. In India, the demand for the PET films is expected to continue at 8 to 10%. So in India, the market is growing faster than the overall globe. The global thin PET market is expected to grow at 5 to 6%. In terms of total capacity expansion, if we see, the capacity is expected to grow at a range of about 5.5% CAGR up to 2026. Now, what are the trends and why is the demand in this sector expected to grow? Because of the population growth, urbanization, people are leading a better quality of life, they are buying more affordable products, consumerism increasing the lot of packaged food consumption, and e-commerce is also giving a boost to this industry. In terms of end use, if you see the global thin PET film market, majority of the use of these products are into the packaging. Almost 75% of the usage is in packaging, and electricals is about 8% and the remaining industry is about 7%. By region, if you see the global thin PET film demand, China accounts for about 46% of the demand of the world, Europe about 10%, India about 12%, Middle East about 2%, America about 10% and rest of the world about 19%. In terms of capacity now, if you see, in China, the capacity is about 44% of the globe. So China is one of the major producer as well as consumer of the thin PET films. Middle East and Africa is about 9%, Europe about 4%, America about 9% and India about 14%. So now what do you observe in this? In terms of demand, India has about 12% of the demand, but in terms of capacity, we have 14%. So we have enough capacity as per our demand and that is why we are exporters. America accounts for capacity of 9%. Whereas the demand is 10%, so America is a net importer of thin PET films. Europe demand is about 10% as well as capacity is just 4%. So Europe is net importer of thin PET films. So the countries like India and China who have excess production are exporting to countries like US and Europe. In terms of capacity utilization globally, if you see, the capacity utilization is fairly constant over the period of the last 10 years, we have been witnessing the capacity utilization at an average of about 70 to 80%, and it is expected to remain in the range of 70 to 78% in the next few years. Now, coming to the thick PET film, in terms of demand globally, industry wise, if you see, usage is maximum in the electrical and electronics of the thick PET film. Roughly 67% is in electricals. In packaging, the thick PET film is less, it's about 10%. In imaging about 10%, and the other industries about 13%. In terms of region, China again accounts for about 49% of the demand, Europe about 9%, Korea about 11%, Japan about 11%, America about 11%, India about 2%, and the rest of the world about 7%. So in terms of demand, the major consumer of thick PET films are Japan and South Korea, along with Europe and America. And China remains the global leader in terms of demand. In terms of capacity, again, China is one of the highest producer of thick PET films, followed by Korea at 16%, Japan at 10%, rest of the world 11%, and the others about Europe, America and India about 5, 6 and 2%. Now, capacity utilization of the thick PET films, if you observe, is going down. So compared to the thin PET film, the capacity utilization is not maintained, which indicates that the demand is slightly slowing down for the thick PET films. Now coming to the BOPP films, which is another product of this company. In BOPP films, the food packaging industry consumes about 64% of the demand, non-food packaging about 18%, and the other industries about 17%. In terms of demand by region, the BOPP films, China is about 46%, Europe 15%, America 14%, rest of the world 13%, and India and Southeast Asia about 6 and 7%. In terms of capacity, again, China leads in BOPP film also about 46%, followed by Europe at 16%, America at 13%, rest of the world 12%, and India and Southeast Asia about 6 to 7%. Now, capacity utilization of BOPP film went down for a few years in the middle, but now it has picked up again and ranges about 70 to 72% in the recent years. So this is about the industry in which the company operates, and the industry has fairly constant demand, fair amount of utilization of the global capacities, as well as growth in the capacities by various countries. Now let's talk about the management of the company. The chairman of the company is Mr. Sanjeev Saraf. He is also the founder of the company. He is alumnus of IIT Kharagpur. He has more than 37 years of experience in the industry, and he's a first generation entrepreneur. The CEO is Mr. Pranay Kothari. He is also an executive director of the company, and he's associated with Polyplex since 1985. So he's also a veteran in the industry. Now let's understand the journey of the company and what are the key milestones the company has achieved throughout its journey. They started in 1988 and they listed the company publicly in 1988, and they set up the first BOPET film in Khatima, India. In 1996-97, they started their first resin plant. So immediately they got a backward integration done. In 2002, they started a metallizer plant. Now by doing this, they have done a forward integration. So by this, you understand the attitude and the vision of the company. Immediately after starting their production, they have started backward and forward integration within the first few years of starting the business. Next, in 2003, the first and second plants of the BOPET film, they started in Thailand. So they started a global expansion in 2003, and in 2004, they even got their Thailand company listed publicly in Thailand. And they also did a backward integration in Thailand with their resin capacity. In 2005, they entered Turkey and established their first BOPET film in Turkey. In 2006 to 7, they did backward integration in Turkey, and they also set up a silicon coating line in India, which is a forward integration in India. In 2008, they set up their first extrusion coating line in Thailand, which is again a forward integration in Thailand, and they expanded their capacities in Turkey. So going further from 2010 to 2013, they continued their further capacity expansions and forward and backward integrations at their various locations. And this continued up to 2018. They expanded further capacities in all the locations which they entered, like Thailand, US as well as India. In 2019-20, they started manufacturing in Indonesia as well. And in 2021-22, the further expansion in Indonesia as well as the other location continues. In terms of group structure, the Indian company is the parent company. They have 50% holding in the Thailand subsidiary, which is PTL Thailand. And there are 3 wholly owned subsidiaries in the Thailand company, which is PE Turkey, PU USA, and as well as PFI Indonesia. So all the 3 other subsidiaries are wholly owned subsidiaries of PTL Thailand, and the Indian parent company holds 51% stake in the Thailand company. What are the different applications of the products of this company? You can see on the screen that they are used in packaging of various food products. They are also useful in packing various personal care products like health and hygiene products, labeling of the different products. They have also having use in the industrial, electrical and electronic items. They have usage in building and construction products, thermal lamination products. They are used in digital printing, and there are various other usages, innumerable usages of the products which the company manufactures. Now let us look at the company-wise breakup of revenue. Polyplex USA accounts for about 26% of the total revenue. Polyplex India accounts for about 23%. Thailand accounts for about 18%. Turkey accounts for 17%. Indonesia accounts for about 11%, as well as the other locations account for about 5%. So you can see that the revenue is quite well diversified, and there is no concentration of revenue on a single specific geography, which is a very good advantage for this company. In terms of countries, America accounts for about 27% of business, Europe 23%, other Asian countries about 27%, India 18%, and the rest of the world 5%. So in terms of geography, also the business is quite well diversified. Segment wise revenue breakup, if you look at, the thin PET film accounts for 56% of the business of the company. The coated films, which is the value added product, constitutes about 14%, OPP about 9%, thick PET films is just 6%, CPP and blown PP about 4%, chips about 5%, and other products about 4 to 6%. Overall, in terms of application, if you divide, for packaging, nearly 70% of the revenue comes from the products which are used in packaging, and other industrial applications about 30%. Now let us look at the competitors of the company, and let's understand how this company is comparable with them, as well as in terms of valuation. Let us compare. So Polyplex Corporation has a market cap of about 8,500 crores, and other competitors like Jindal Poly has about 5,000 crores, Uflex about 5,000 crores, and Cosmo Films about 4,000 crores. So in terms of market cap, this is one of the biggest companies in the sector in the listed companies category. In terms of revenue, it accounts for about 6,000 crores of revenue, compared to Jindal Poly about 5,300 crores and Cosmo Films about 3,000 crores. But Uflex leads in terms of revenue and is almost double the size of revenue of Polyplex, which is about 12,000 crores. EBITDA margin is quite decent compared to its competitors. It's about 19% for Polyplex, and others range between 17 to 23%. In terms of ROCE, Polyplex is performing well, about 26% of return on capital employed, compared to Jindal Poly, which is clocking about 32%, and Uflex about 15%, as well as Cosmo Films about 23%. In terms of market cap to sales as a valuation metric, Polyplex accounts for about 1.4 times, and Jindal Poly 0.96, Uflex 0.42, and Cosmo Films on 1.24. So in terms of market cap to sales, Polyplex valuation is the highest in the industry. In terms of PE ratio, it accounts for 17 times the earnings. Jindal Poly accounts for almost 5.5 times the earnings, and Uflex is about 5 times. Cosmo Films is about 10 times. So in terms of price to earnings also, Polyplex valuation is the most expensive in the comparable peers in the industry. In terms of capacity of manufacturing, Polyplex is the 7th largest in the thin PET category in the world, and except China, if you see, globally second in the thin PET film in the world. Now, what are the competitive strengths or economic moat of this company, and why you should be investing in this company and not the other companies of the sector? So this company has a very experienced team. The promoters are into this business for more than 3 decades. They have done a lot of patents and trademarks. They have 27 patents granted and 14 patents under the filing. They have 6 trademarks granted and 6 trademarks under the filing. This shows that the company is quite innovative in the products which they manufacture. They have vertical integration. They manufacture resins as well as the value-added films. So this gives them an advantage over their competitors. The customers get to buy everything what they want under one roof. They have less impact of the raw material fluctuations. They have less impact of the finished product demand. Their manufacturing locations are located worldwide in different countries, so they can serve their customers faster and their operating efficiencies are better. This gives them the cost leadership compared to the other competitors, and that is why they keep gaining market share over a period of time. So these are the competitive strengths of this company. Another interesting thing which you should keep in mind about Polyplex is it is one of the industry's trendsetter. Why we are calling it a trendsetter is because it has become the first one to do a lot of things. Like it has been the first in the industry to operate a 10.6 meter line at 675 mpm. We will not get into the technicalities, but the thought here is just to understand that it is leading the industry in doing new things, which is a very good gesture from innovation point of view. They have done forward integration into metallizing, which is the first one who has done compared to the other people in the same industry. They have forayed into digital printing films. As an Indian producer, they were the first ones to set up manufacturing operations across the globe. They are the only company globally who has a well backward integrated PET resin plant across the globe in all the manufacturing units. So these are the few examples by which you understand they have been trendsetters in the industry in which they operate. Now, what are the growth prospects of this company and how you can expect this company to do better in the future? The share of the value added films in their revenue is going up over a period of time because of their forward integration. This will increase the amount of business which they get, as well as this will increase the margin which they earn in business, which is good in terms of business for this company's growth prospects. They have a huge line of capex planned across various locations across the globe, and they are continuously forward integrating and expanding their product portfolios, and they are also looking at environment friendly products. Now, whatever we have discussed can be understood more clearly from this chart. Compared to the earlier years, the dark blue color is the specialty film. The specialty film share in the revenue is going on increasing from 24% to 37% in the latest financial year. This shows that the specialty films is growing, as well as the higher margin business is growing in the revenue share. These are the several capex plans of this company which are about to be completed and coming into production. So this shows that there is continuous capacity expansion in various products across different locations, as you can see on the chart. In terms of capacity expansion across the several years, Polyplex is increasing the capacity more than the industry peers. They have grown, the capacity of the company has grown at a CAGR of 8%. So here we are talking about volumes and not value. So this shows that the company is witnessing strong demand year after year right from the last decade. Another interesting thing to note is the capacity utilization. An average industry capacity utilization ranges between 7 to 80% in this industry, whereas Polyplex is almost operating at full capacity since the last 3 to 4 years, and they are further expanding their capacities. This shows that they are in a sweet spot and they are in a leading position. That is why their capacities are fully utilized. Now, what are the risks which this company or this industry faces is this industry has very tough competition because there are a lot of organized players, as we have discussed earlier in the competitor slide, as well as they are localized unorganized players which give tough competition to companies like Polyplex. In terms of business, this business is a little cyclical business because their raw material prices are dependent on the commodity prices like the oil and natural gas prices. So their margins keep fluctuating, and that is why in terms of valuations, generally this business is given lower valuations. There is a risk of environment sustainability because government is slowly trying to discourage the use of plastic and they are moving towards other substitutes like paper. Then other general risks like the exchange risks, regulatory risk, all those things which are common for the other companies exist. But the main risks for this company are competition, the risk of environment safety, as well as the volatility and cyclicality in the business of the company, which has to be surely kept in mind whenever you are investing. Otherwise, if you run out of the stock and just sit on the top, then you will be badly stuck. Now, after understanding the business, the industry completely, let's talk about the numbers. Starting with the quarterly results, the Q4 results are not yet announced. The revenue is 1751 crores in Q3 FY22 compared to the earlier year 1237. So revenue has seen a very good growth. EBITDA has gone up from 329 crores to 349 crores. EBITDA margin has reduced from 27% to 20% because of the inflation across the globe. Profit after tax has gone up from 131 crores to 175 crores. Profit after tax margin is somewhat stable at about 10%. Now let's talk about the yearly numbers. The revenue has gone up from 3,500 crores to about 6,000 crores in the trailing 12 months. It has grown at a CAGR of about 14%. EBITDA has grown at a CAGR of about 23% from 494 crores in 2018 to about 1144 crores in the trailing 12 months. EBITDA margin has gone up from 14 to 25%, but they have seen a little pressure in the trailing 12 months and come down to about 19% because of the inflation. Profit after tax has gone up from 159 crores to about 500 crores in the trailing 12 months and growing at a CAGR of about 33%, which is very impressive. Profit after tax margin has improved from about 4 to 7% in the earlier years, about 8 to 10% in the recent years, but in the trailing 12 months they are feeling a little pressure of the inflation. Equity has gone down from 33 to 32 crores. This may be because of the buyback done by the company. The reserves have gone up from about 2,500 crores to about 3,100 crores in the year 2021. The borrowings are somewhat stable. They have about 800 crores of debt on the balance sheet because they continuously keep doing capex, but this is well under control as the debt equity ratio is just 0.26. The trade payables have gone up to about 400 crores. This is okay with the growth of the company, but this has to be closely watched going further so that there should not be any abnormal movements in trade payables. The fixed assets are fairly constant because they keep providing depreciation. They, in spite of doing capex, the fixed assets remain somewhat in the same range. They are about 2,600 crores on the balance sheet. Inventory has gone up from about 500 crores to 1,000 crores, but this is in correlation with the revenue of the company, which has grown. Trade receivables have gone up to about 800 crores and these are also in line with the revenue growth. Debtor days have come down to about 50 days, which is good for the company. The ROCE has improved to about 26% in the FY21. Cash equivalents, there are about 950 crores of cash on the balance sheet in the year FY21. The operating cash flow has always been positive. In fact, it has improved to about 1,100 crores in the year 21, and free cash flow has also been positive every time, and they have generated about 570 crores of free cash flows in FY21. ROE is about 16.8%. This company pays very good dividend and the dividend yield ranges between 5 to 7%. The remuneration to executive director is about 3.93 crores. Auditors are not a big four firm, which is SS Kothari Mehta and Company, and there are no risky material related party transactions in the company. Now let's study the shareholding pattern. The promoter hold about 51% of the stake, public about 34.8%, DI is about 4.8% and FI is about 9.29%. An interesting thing to note in the shareholding pattern is one of the marquee investors, Dolly Khanna, has been increasing stake in the company in the last 2 to 3 quarters. This is the shareholding pattern of the subsidiary of the company, which is listed in Thailand. There about 51% is held by the Indian company. Institutions hold about 40% and non-institutions about 8.5%. Now let's talk about the valuations, which is going to be interesting for this company. Last rate price is 2765 and 52-week high and low is 2800 to 800. The last 1 year, the company has given about 250% of return, which is excellent for its shareholders. And in the last 3 years, the average CAGR is about 70%. Last 5 years, average CAGR is about 40%. So in terms of stocks, this stock has performed very well in the last 5 years and made its shareholders very happy. The last 5 years, median PE is about 7 times. So that's why I say that this particular sector is generally given lower valuations by the shareholders. The market cap is about 8,500 crores after the rally in the shares. Face value is 10, EPS is about 161 rupees and PE is about 17 times. In terms of PE, if you compare with the peers range between 5 to 10 times the earnings. Book value is about 998 and PB ratio is about 2.7. The market cap to sales is 1.4. So in terms of valuation, if you compare with the others in the industry, this stock is overvalued. Now let us look at the chart. The stock has given a very good rally recently and it is trading somewhere around 2,500 to 600 presently. But it is not advisable to chase the stock at the current levels, and if you get it somewhere around 1700 or so, it could be a good level to slowly accumulate this stock. So this is about Polyplex. I hope you like the analysis. To summarize, the management is very well experienced. The company is a global leader in the business they do. They are setting trends in the industry as they are one of the first to do forward and backward integrations globally. They are vertically integrated, which gives them cost leadership as well as operating excellence, and their presence in various countries, the manufacturing units, helps them to provide better service to their clients. They are continuously doing capex, expanding their production capacities. The fundamentals of the company are very strong. The industry is also growing very well, so the company will witness tailwinds of the industry. But few things to be kept in mind is this industry is kind of cyclical and the margins of the profit will continuously fluctuate. So you have to keep those things in mind before investing in the company. It is a low PE sector because generally these kind of companies are not given very high premium valuations by the market, and there is intense competition in this industry. There is a risk of environment if the governments become very strict, and if there is any kind of a ban on the use of plastic, these kind of companies might be affected. And in terms of valuation, the stock has given a very big run up recently, though. So at present it is in kind of a overbought zone and it is overvalued. So in case you like to invest in the company, you should keep in mind that you should invest at the appropriate valuations only. So this is about Polyplex. I hope you like the analysis. If you like it, hit the like button and subscribe to the channel. Don't forget to join our Telegram channel where we discuss a lot of interesting stuff on a daily basis. If you want me to make videos on your favorite companies, do comment the name of the company in the comments below. I would be happy to make videos on those companies. So thank you so much for watching this video and have a wonderful day.